Picture this. You buy one share of Apple stock for $100. A year later, you check your account. It's worth $130. You made $30 without working a single extra hour. Now here's the question most people never actually ask. What just happened? What did you actually own? And why did that number go up? Because if you can't answer that, you're trusting something you don't understand with money you worked hard to earn. Here's the wild part. Millions of Americans own stocks. Through their 401k, through their Roth IRA, through an index fund. And most of them have no idea what a stock actually is. They know the number goes up and down. They know it's supposed to be good for retirement. But the mechanics? The reason it works? Nobody explained that part. My name is Max, and today I'm going to break down exactly how stocks work, how they make you money, and why you don't need to be a Wall Street expert to use them correctly. This is the video I wish someone had shown me before I started investing. Let's start with the simplest possible definition. A stock is a tiny piece of ownership in a real company. When Apple needs money to build new products, they can borrow it from a bank, or they can sell small pieces of the company to the public. Those pieces are called shares. When you buy a share, you are a part owner of Apple. A very small part, but an owner. That's it. No magic, no mystery. You're buying a slice of a business. Now here's where it gets interesting. Because owning a piece of a business means two things can make you money. The first one is price appreciation. The second is dividends. Let's take them one at a time. Price appreciation is the one most people think about. You buy a share at $100, the company grows. More people want to own it. The price goes up to $130. You sell. You kept $30. But why does the price go up? This is the part that actually matters. Stock prices are driven by earnings, how much profit the company makes, and expectations about future earnings. When a company is growing fast, making more money every year, investors are willing to pay more to own a piece of it. When a company is struggling, they're willing to pay less. That's why Amazon stock went from almost nothing to over $100 a share. Not because of hype, because the business got dramatically more profitable over time. The second way stocks make you money is dividends. Some companies, especially older, stable ones like Coca-Cola or Johnson & Johnson, take a portion of their profits and send it directly to shareholders. Every quarter, they deposit cash into your account just for owning the stock. Think of it like rent. If you own a rental property, you collect rent every month. If you own a dividend stock, you collect a payment every quarter. The company is literally sharing its profits with you. Not all stocks pay dividends. A lot of growth companies reinvest their profits back into the business to grow faster. But for the ones that do, it's a real, tangible payment. No need to sell anything. So you've got two ways to make money. The price goes up, and the company pays you along the way. Now let's talk about the other side, because stocks don't always go up. Volatility is the word people use to describe how much a stock's price moves around. And stocks are volatile. Some days they're up 3%. Some days they're down 5%. Some years the whole market drops 20 or 30%. This is normal. This is expected. And this is actually why stocks produce higher returns than a savings account or a bond over the long run. Because you're being compensated for tolerating that uncertainty. Here's the number that matters. Over the last 100 years, the U.S. stock market has returned an average of about 10% per year. Not every year, but averaged out through crashes, recessions, wars, and pandemics. 10% per year. A savings account returns about 0.5%. The difference over 30 years is staggering. Let's make this concrete. You invest $10,000 in a savings account at 0.5% for 30 years. You end up with about $11,600. You invest the same $10,000 in the stock market at 10% for 30 years. You end up with about $174,000. Same starting amount, same 30 years, 15 times more money just from where you put it. Now, I know what you're thinking. What if I pick the wrong stock? What if I buy something that goes to zero? That's a real risk with individual stocks. Companies do fail. Blockbuster, Kodak, Enron. If you had put all your money into any of those, you'd have lost it. But here's the move that eliminates that risk almost entirely. Instead of picking individual stocks, you buy an index fund. An index fund owns a tiny slice of hundreds or thousands of companies at once. The most popular one tracks the S&P 500, the 500 largest publicly traded companies in America. Apple, Microsoft, Amazon, Google, and 496 others, all in one fund. When you buy one share of an S&P 500 index fund, you own a small piece of all 500 of those companies simultaneously. If one company fails, it barely moves the needle. If the overall economy grows, and historically it always has, your fund grows with it. Index funds have one more advantage that most people overlook: cost. When a fund manager actively picks stocks, they charge you a fee for that, usually around 1% of your money per year. That sounds small. On $100,000, it's $1,000 a year. Every year, compounded over 30 years, that fee can cost you hundreds of thousands of dollars. Index funds don't have managers making active picks. They just follow the index automatically. So the fee, called an expense ratio, is almost nothing. Most S&P 500 index funds charge around 0.03% per year. That's 3 cents on every $100. Same market returns, 97% less in fees. So let's put this all together. A stock is ownership in a company. Stocks make you money through price appreciation and dividends. Prices go up when companies get more profitable. Volatility is normal and temporary. Over the long run, the market goes up. And the single best strategy for most people, backed by decades of data, is to buy a low-cost index fund, hold it for a long time, and let compounding do the work. You don't need to watch financial news. You don't need to follow earnings reports. You don't need to know which sector is hot right now. You need to buy consistently, hold patiently, and stay out of your own way. Warren Buffett, arguably the greatest investor alive, has publicly said that when he's gone, he wants his family's money put into a simple S&P 500 index fund. Not a hedge fund, not an actively managed portfolio, a plain index fund. If that's good enough for him, it's probably good enough for the rest of us. One last thing before you go. The best time to start is now. Not when the market is at the right level, not when you have more money, not when you feel more confident. Now. Because every year you wait is a year of compounding you don't get back. If you're not sure where to open an account, check out my video on the Roth IRA. It's the best account for most people starting out, and the link is right here. And if this video helped you understand something you've been fuzzy on for a while, subscribe. I put out a new video every week, and they're all exactly like this one. Honest, plain English, no hype. I'll see you in the next one.